What's up guys, it's James Allen, the Out-of-State Investor, and today we're going to talk about which loan is the best way to go between a conventional loan or an FHA loan. Now, choosing the right type of loan can literally be the difference of saving yourself thousands of dollars or even saving yourself from getting locked into things that you might not realize is in the fine print. So just the fact that you're watching this video right now is already a great start. I'm going to give you some great information today on both of these mortgages so that you can know for a fact that you getting exactly what's in your best interest. Now, before I get started, do me a favor, support the channel and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. All right, so the way I'm gonna break this down is I'm really gonna go category by category as far as what you need to know when you're looking at loans like this and compare what you're getting with a conventional loan versus what you're getting with an FHA loan. Now, the first place to start would be down payment. Now, for your down payment on an FHA loan, you're looking at a 3.5% down payment from a 1 to 4 unit property. So that means that you could get a single family with 3.5% down, and you can even get a fourplex if you wanted to with 3.5% down. Now, with a conventional loan, you can actually go even less than 3.5% down, as low as 3% down, but there are a little bit of rules and regulations that go along with that. One of those is that one of the buyers has to be a first-time home buyer or has not purchased a home in the last 3 years. Now, if that's not you, then the other alternative is you can also go for a 5% down minimum payment for your conventional loan. And not only that, but it also doesn't qualify for 2 to 4 units. You see, for those bigger properties like a duplex, triplex, a fourplex, you're going to need to put down even more money. For a duplex, you're going to need to be looking at about 15% down, and then for a triplex or fourplex, you're going to need to put as much as 20% down. And again, we're talking about purely if you're living in the property. Otherwise, in that case, it's going to be even more money. But right now, we're talking purely about living in these properties. The next thing I want to talk about is your credit score. You see, the credit score that you have is going to determine the type of interest rates you get, and not only that, if you'll even qualify for the loan in the first place. For conventional loans, you're going to start at a 620 minimum credit score. That's the absolute minimum to even qualify for the loan in the first place. But at that rate, you're probably going to be getting a very expensive loan. Ideally, you really want to be over 740 to get the best interest rates, but at least at 620, you can still qualify. Now, if your credit score isn't as good as that, you still have options with your FHA loans. You see, FHA loans will go down as low as 580, still keeping that 3.5% down payment. Now, if you have even lower than a 580 credit score, the good news is the banks will still lend money to you. They'll still give you, as long as you have a 500 credit score, they'll still give you an FHA loan. However, if you're under 580, you're somewhere between that 500 to 580 mark, they're going to require a 10% down payment. The next thing I want to talk about is removing your mortgage insurance premium. Now, for those who aren't aware, if you put down less than 20% down, you're going to end up having this thing called either PMI or MIP. Basically the same thing, but it's basically an extra insurance payment that you have to pay to the bank because you put down less than 20%. Now, what many people don't realize is that with an FHA loan, the only option to remove this is by refinancing your loan. If you don't refinance the loan, that mortgage insurance premium will never go away. The only exception to that is if you actually did a 10% or more down payment with your FHA loan, then after 11 years, the MIP will finally come off. Now, with conventional financing, you don't need to refinance in order to remove your mortgage insurance premium. And this is a big deal because refinances cost thousands of dollars. So if you can avoid that, that's putting a lot of money in your pocket. With conventional financing, once the balance of your mortgage is at 80% of what the original appraised value was, that's when you can call your lender up and ask them to remove PMI. And when the balance drops to 78%, the lender is already required to remove the PMI from the loan. So if the house was originally appraised at $200,000 and your mortgage balance gets down to $160,000, which would be 80%, that's the moment when you can ask the lender to remove the PMI. And on top of that, with this recent housing surge that we've seen, with prices going up at astronomical rates, if you have 20% equity today, which basically anybody who's bought a house in the last year or two probably is sitting on 20% equity, even if you put down 5%. So if that is you, many times you can actually call up the lender and have them do an appraisal, and if it appraises to where you have 20% equity, you can actually remove the PMI even earlier than the 7.5 years or whatever it takes to pay down to 80% of the mortgage balance. In fact, that's actually what I'm doing on a house I purchased this year. The housing market has surged since I purchased the house, plus I added value to it by fixing it up, and so because of that, I already have more than 20% equity in it, so I'm already starting the process to remove the PMI in less than a year. It depends really on the lender though, because some lenders may require 2 years of seasoning before you can do something like that. Some have no requirements whatsoever, so you just need to call up your lender in order to understand what their requirements are. The next thing I want to talk about are loan limits. You see, the FHA loan and the conventional loan have different parameters as far as what they allow you to go up to as far as a loan amount. Now, this is really going to depend on an area by area basis, but overall they have a baseline level amount of what they offer for the majority of areas nationwide, and then there's loan limits for the more expensive areas like Los Angeles, like New York or San Francisco, areas where the average price of the house is a lot higher than what the national average is. So for FHA loans, the baseline loan limit for nationwide is $356,362. Now for the ultra expensive markets like San Francisco or Los Angeles, they'll go as high as $822,375. And remember, this is for the loan amount, not the purchase price. So you could purchase at $900,000 but get a loan up to $822,375. Now in my market of Phoenix, FHA will actually go up to $368,000, and that's their adjustment for what they see is fit for the market of Phoenix. Now for comparison's sake, with conventional loans, their baseline loan limit, and this is nationwide, is $548,250. This is actually the same amount that it is for the Phoenix market, and if you go to the more expensive markets like Los Angeles or San Francisco, they'll go up to the exact same amount as the FHA loans, which is $822,375. So if you live in one of the expensive markets, it's really not going to make a difference which way you go as far as loan limit is concerned. But if you live in a cheaper market like a Phoenix, it could be the difference of $200,000 of what you can qualify for. Now, one of the biggest things that people don't talk about enough is the cost of closing costs. You see, people don't realize that closing costs are actually a lot more expensive when it comes to FHA loans than closing costs. And the big reason for that is there's what's called an upfront MIP. Now, we already talked about MIP, that stands for mortgage insurance premium. Now, not only do you incur that as part of your FHA loan and your conventional loans for that matter, but you also have an upfront MIP charge, which is 1.75% of your loan amount. So in other words, if you were to get an FHA loan in the amount of $300,000, you'd have an upfront MIP charge of $5,250 added to your closing costs. Now, if you don't have that money and you're still thinking you gotta go the FHA route, the good news is that you can actually roll those closing costs into the loan, which does increase your loan amount that you have to pay, but at least it saves you that money come closing time. And like I said, this is really a thing for FHA loans. For conventional loans, you really don't have to worry about any kind of charge like this, which is why closing costs are way cheaper. Now, when it comes to mortgage interest rates, typically an FHA loan is going to be a little cheaper than conventional loans, but you really have to look at the credit score because that could really play a huge role in dictating what is more expensive. Now, as far as mortgage insurance rates go, it can get a little complicated because it's not just about what your interest rate is. You also want to consider your mortgage insurance if you're putting less than 20% down. You see, you want to combine these two together. So for FHA, for instance, you have a flat 0.85% fee that you're going to be adding onto the loan. So if you have a 3% regular interest rate and then you have 0.85% for your mortgage insurance premium, your total combined interest rate is really going to be 3.85%. Now, it gets even more complicated when you look at conventional loans because the better your credit score, the lower the interest rate, and it really has a strong effect on what your PMI cost is going to be. So it's kind of hard to dictate which one you're going to get a better interest rate on. You really had to talk to your lender to have a real good idea of what that looks like. But as a general rule of thumb, if you have a really good credit score, you're probably going to be better off with a conventional loan. And And if you have a really poor credit score, you're probably going to be better off with an FHA loan. Now, one of the major differences between FHA and conventional is FHA has a lot more restrictions when it comes to appraisals. And this is a big deal. You see, if you're making an offer on a house, sellers look at if you're offering with an FHA loan or a conventional loan, because if you have an FHA loan, it's going to come with a lot of restrictions that it won't appraise unless it meets those expectations. And some of those are things like the roof needs to be in good condition and general satisfactory condition for the house in general. So if the house is a serious fixer-upper, it could cause some serious issues. Or if there's been some deferred maintenance on the house, when the appraisal comes into play, that may be the difference of even being able to close on the property altogether. Now, this matters to you as the buyer, because if you're trying to offer with an FHA loan, a seller might see your loan versus a conventional loan and go, well, he may be offering more with an FHA loan, but I don't know if it's going to close. I don't know if the house will appraise. So conventional is definitely the more flexible loan as far as restrictions and things of that nature. So if you're looking for a fixer-upper house especially, conventional loan is going to be hands down the way to go. But even if you're not looking for a fixer-upper and you just want to be more competitive in your offer and you just want to stand a better chance of getting your offer accepted, a conventional loan is always going to look stronger than an FHA loan. So anyways, I hope you found this video helpful as you're trying to figure out whether you're better off with an FHA loan or a conventional loan. I'll tell you firsthand that I personally prefer conventional loans. I find them to be better as far as the flexibility you get with being able to not having to refinance with your PMI and things of that nature. But overall, I hope you guys gained some value with this video, and if you did, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments if you have any questions or feedback you want to give me, and I'll do my best to respond. Finally, follow me on TikTok and Instagram at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.